With the markets being quiet, let's talk a bit about the risk reward ratio and trading tactics. A lot of people, when you read up and look at videos, you think you need to have a very high risk reward ratio. And that forces people to have tight stop loss orders to really obtain this risk to reward ratio. But I think they're missing out from something important here, which is risk to reward ratio before you trade and risk to reward ratio after. And obviously, we do care about what happens before, but what is after is what is the truly important thing, right? 100 things could have happened, but at the end, if we made money, we made money. Does that make sense? So let's take a look at this and practicality here. Because, say, for example, this is an idea, by the way, that I shared in gold a couple of days ago. So here, for example, the idea was to be bullish from here with a stop loss here, unless you wanted to tighten it up here, okay? So if you're looking at this and you're just looking for a revisit of the old high, then you would say, don't trade this trade. And you would say, why not? Well, because the risk reward ratio is 1.28. So you're not compensating for your risk here. And that's correct. In the short term, you are not compensating for your risk here. So what do people do? Well, they tighten it up maybe like this. Suddenly you have a 2 times risk reward ratio. But more people even do it even more. So they look for quite extreme corrections, maybe. So they do something like this. And I noticed that the problem with this is that when you go too tight because you want to enforce a very high risk reward ratio, you will usually be stopped out. Now, the whole idea of having this type of risk reward ratio is that when you do win, like in this case, if we stop out here and then we have a win, if we have one win like this, will compensate for our losses. But look at it from this perspective. Okay, so we're starting here, all right? And if we're right here, so if we ignore reward ratios for a second and just think about the fact that we're dealing with an uptrend and that we're now back at resistance, which acted a bit like support so far, and then we have support here. So if we think about the fact that this actually will bottom out here, let's imagine it does bottom out here. Maybe it goes a little bit lower, but then ultimately spends a day or two here and then goes up. So what happens here? Well, when this starts to go upwards, we can reduce our stop loss. So say we reduce it to just below here. So what's happening now? Lo and behold, we have a risk to reward ratio of 5.83. So your pre-trade risk to reward ratio does not have to match with your post-trade outcome. And this is something I discovered when I was working as an analyst at FXCM many, many years ago. That when I looked at some 350 trades or so, trades for a whole year, and analysis for a whole year, that this was the outcome. It's not going to be a situation where you almost get it right. So the reality is that your risk reward ratio is going to be somewhere between the 1 to 1 to maybe this extreme, which will be like 8.82, right? Does that make sense? So from that perspective, you don't have to be too close to all the action. Your job would still be, of course, to ensure that you know how to identify a trend and that you identify good levels to enter, you know. And then by doing this, you avoid A, getting stopped out, or number two, not even getting into the trade, which is usually what happens many times because people would look at maybe something like this, tight stop loss like that, and it might not even reach that level. So that's what I can share with you guys today. I hope you found this useful. Let me know your thoughts in the comments below. Thank you.